Hey everyone, thanks so much for joining. My name is Winter Mead with Coolwater Capital, founder of Coolwater Capital. We have offices I have my colleague here from New York. We have offices in San Francisco, LA, New York, and we recently launched in Tokyo. We're a GP seeder investor for emerging managers. So we mainly work in private equity and venture capital. We've built a model, think of it as an incubator or accelerator, but it's for investment funds. And so over the last 4 years since launching this model in the US, we've helped over 200 mainly venture capital firms build their businesses, build their investment firms, and raise around $4 billion. And again, these are micro funds. These invest into early stage technology startups. And the connection to this panel is most of the startups that they're kind of, selling into in terms of like the next round of financing is usually a growth stage investor. So again, across venture capital and private equity, and kind of we're usually the round or two before they make it to growth. So we kind of have that perspective of early stage looking towards growth.
Hi everyone, I'm Herbin. So I head up the private equity, growth equity business at Gore. We're a Hong Kong-based private equity firm. People used to know us as a hard asset platform. So as a group, we have about 14 offices globally. But within the private equity arm, I started kind of the business with the Gores 8 years ago. So we predominantly focus on growth equity stage companies relating to the hard asset. So I don't invest into the hard asset, but I invest into the technologies that are relevant to the hard asset. So it would be things related to properties, related to infrastructure, to the grid, and to these days battery solutions and battery storage, EV charging, the whole gamut of climate-related, even data center-related technologies. We invest into that. We typically write 20 to 50 million ticket size per deal. And I have teams across Asia that works with me for this strategy.
Hi, good noon, everyone. I'm Helen Chen from FGA. I'm the Chief Strategy Officer. So at FGA, we manage a lot of different asset classes for our families, offices, clients, and corporate clients. So we're based in Hong Kong, so there are a lot of things we could do that we offer better solution than the traditional financial institutions because we have the tech enhanced platform to support different sort of asset classes and different sort of engine of return.
Hello everyone, I'm Dennis Luke from YF Life. I'm the Chief Investment Officer of the firm. So YF Life is a life insurance company. Our shareholders include YF Financial Holdings, and indirectly we are owned by MassMutual at the Listco level as well. And of course, YF Capital is also one of our sister companies, so we have a GP relationship as well. So my role as a CIO of the life insurance company, we basically manage the investment portfolio. We manage today around $10 billion assets, a very diversified portfolio across fixed income. At the same time, we are LPs, asset allocators. So we invest in a lot of funds across all different strategies. But of course, technology is one of the key pillars as well. So happy to be here and share with you all.
Thank you. So to get us started, I know some of you do public, some of you do private, some of you do a bit of both. So just riding off of that, how are your companies and or its clients viewing private equity and public markets during the current macroeconomic challenges and down cycle? Dennis, maybe we can start with you.
Sure. Being a life insurance company, I think we are conservative in general, but I think we're also innovative in terms of our investment strategy. So we have been using alternative asset, private assets since more than 15 years, I believe, and even before the YF Financial Group acquired the company. So myself, we have been allocating capital to private funds for more than 15 years now. So basically, we love the asset class a lot, but being a lifers, I think we maintain a very diversified strategies. We have most of our assets to match our liability that derived from the policyholders' obligations. So we basically maintain a fixed income portfolio. But within that, we also apply a lot of alternative asset allocations. So we invest in private credit, private debt opportunities. And at the same time, on the technology space, we love private assets as well. I think in the current market, it's volatile. I'm not sure whether this is a cooling down market if we look at the economic data. But obviously, I think volatility is increasing, and then private assets, I think, is one of the asset class at least that we see a lot of yield enhancement opportunities. We see a lot of managers that they have been delivering a lot of return by generating value creations. So we basically love this asset class, and we continue to allocate capital steadily and across different strategies. And in tech space, I personally believe that's also perfect for using GPs or funds investment. Basically, we see a lot of managers that they have been able to identify where we are in the cycle. They can deploy different strategies to take different opportunities that would not be available in the public space. And in general, I believe private assets is also increasing areas where we have been allocating more capital to it.
So again, my perspective is very like private equity, venture capital. I think there's still a massive opportunity within alternatives. From the private equity perspective, so I've invested as a limited partner in the U.S. into firms like Thoma Bravo, Bain Capital, Warburg Pincus. That's kind of the private equity technology perspective. Thoma Bravo, for example, if people know, that's let's call it a $20 billion private equity fund investing into technology assets in the U.S. Thoma Bravo 15 years ago wasn't really kind of shopping growth, right? In terms of like this high growth, like even shopping kind of venture. And now if you look at the data, at least in the US, it's about 20 to 30% of exits, right, are being bought by private equity firms, kind of growth firms. So I think there's definitely like an intermingling going on there, right? So venture is interesting, but it's also being sold in. From the institutional LP perspective, both kind of retail, like RIAs, but also institutional, right? They're still allocating. They have to, right? Like pensions have to kind of meet unfunded. Endowments still find it super interesting. So even though we're in a little bit of a sideways market, there's still a massive demand for alternatives, like private equity within alternatives. Again, like at least in the U.S. And then I think within the opportunity within kind of where venture meets growth right now is really on the secondary market, because again, like it's shorter duration. These are still kind of high growth assets. And it does feel like private equity, right, maybe given debt markets, is kind of slowed up a little bit, maybe given public markets, which kind of, the exit avenues are a little bit shorter. So that's where a lot of, I think, transaction volume is going on, kind of in that like early to mid growth. It's through like the secondary markets, continuation funds. So that's where I'm kind of seeing the opportunities from different perspectives in the US right now.
Well, for us, maybe I can share a little bit about our journey as well, or my journey growing the business at Gore, right? Because we are pretty nimble in the market. Nimble in the sense that we react based on where the market changes is, right? If this was 2018, people talking about pre-IPOs, growth equity, investing hundreds of millions into China, and money is cheap back then, right? So companies will list. And you were just thinking, you get into all these unicorns, and within 2 years you list. But these are all just macro, trends. But within Gore, we started back then, basically as a hard asset owner. But I saw opportunities to say, let's go early. Let's go early 2016 at that time into themes like prop tech, themes like operating companies. And a lot of times you need to incubate. You need to put like early stage capital to help these companies to grow. Well, when valuation is cheap or when price, cost of capital is cheap, great. We launch those kind of platforms. But then why there's a growth equity that comes in is because there's a severe lack of growth capital. Even in those days, the last 8 years, in thematic ideas that are capital intensive. So in Asia, I speak from Asia perspective, right? People like software companies. You like these scale ARRs and stuff. But what about capital intensive operating companies? The VCs kind of underwrite it. Because you look at it and said, okay, can I put 20 million and hope for it to grow? The J curve is pretty steep. And then for infrastructure and real estate guys, you have to wait for it to be mature to sign their long-term PPAs and stuff. So that's where I saw the opportunity. I said, why not let's back the growth equity companies or companies in that phase, say in battery manufacturing. Say you're in EV charging where you don't really have the long-term contracts, but if you get to a certain scale, all of a sudden the infra guys come in. If you do it to things like recycling, sort of recycling the sort of facilities, right? Build those facilities for recycling. So we started ourselves, the last 4 years, I got the team to sort of grow because you start to see the world shifting, right? From earlier stage, even in software companies, to suddenly, everybody shying away from this earlier stage. And I come in with a pretty good valuation. So we started going deep and big on it, and we've been pretty much investing in quite a lot of these growth or green climate tech companies in the last 5 years. And that suddenly led to, from early stage to growth, and then I have infrastructure. Because some of these ideas, you can't really invest in it as an infrastructure until you're growth ready for some of these buyouts to happen. And when we look at public exits, it's still, the market is still not there. At least even for any companies right now, right, for valuation-wise. But I do see private equity as an possible exit routes, even in like Southeast Asia or in Asia ex-China markets. So for us, is I guess the point I'm trying to say is we're pretty nimble, and in finding these opportunities, even credit to your point about secondaries. The reason is because we are very nimble to keep taking secondary positions as well in these, and finding new SMAs. So for a GP like us, we will find single institutional capital because 90% of our LPs are sovereign funds and pension funds. So by tapping on these capital, I suddenly could be saying, okay, I see a credit lacking, debt strategy lacking in some of these facilities. Why not let's create a fund and invest in these as a bridge, right, before private capital can come in. So that's the gist of what we have been doing.
Thanks for the sharing. So when to really narrow down into the private sector, but at FGA we don't really frame into a strict private versus public market debate, because our platform support different asset classes of solutions and different products. So we just encourage our clients to diversify into different markets. For those markets the panelists has mentioned, I just want to add on the emerging sectors, including AI and digital assets that we're safeguarding for our clients too. Because of the BTC and ETH ETFs, this year, crypto market alone just adding $2.2 trillion into the market, which is a very significant rise that I just want to bring up to the table, because this is an expansion of asset classes from just public, private, and now into a new blockchain digital asset world. So our clients put a lot of importance and priorities on this part of diversification by diversify a lot of exposure and allocations on the digital assets.
Great. So based off of all of that, we've discussed a little bit about your approach and strategies, focusing more on growth, for example. And Dennis, you said something also about sort of volatile markets. So sort of based on that, how are your strategies evolving? What are you doing differently this year compared to the last couple of years, especially following that sort of post-COVID boom and then now the volatile markets?
Well, maybe I can take this one. We actually work with family office a lot more these days. Predominantly because I think family offices are very nimble. They make decisions very quickly, right? So for the good and the bad, right? The good is that, I get quick answers, yes and no. The bad is that they leave me when the market is bad. Because family offices can be very, nimble, too nimble in the sense that they don't stick to the theme long term to go past the J curve. But in a market like this downturn where, let's say, for example, you have ByteDance secondaries, I have unique opportunities that I need probably only 10 million of credit facility, but you can charge high yield, right? And if I have to go and take $10 million ticket size and go to a sovereign, forget about it. It's a long time. But historically for us, we have been targeting these kind of institutional investors that you spend 3 months, 6 months going through the papers, which is what we still do, right? And pass a mandate. But when you're so nimble now, with opportunities I see coming up that we just need 5, 10 million, but it's out of my existing pools of capital, we started doing some of these by working with family groups, multi-families and whatnot, and it's proven to be quite successful, particularly for the sort of sectors that I said that are emerging, and those or sort of family offices see the gap and they believe in that transition and are willing to take yield, and that's why I see family offices, they like yield, and all of a sudden last 12 months I say we deploy over $1 billion US just on yield generating products, specifically working with family offices. So that's like an extension of our traditional business where we work with institutional capital.
Yeah, we have the mutual strategy with Go Capital because at FGA Trust, we serve a lot of high net worth individuals and families. They have cross-generational approach, which allows a longer time horizon, just like Hermin just mentioned. So in our portfolio, we see a shift from the public market because the public market availability and fluctuation are not what something the family offices they prefer. So they shift into the emerging sector, they shift into fast evolving sectors like fintech and healthcare just because they have the help of AI and add on digitalization and add in a lot of automation of the analytical data tools and some other integrated tools. So they make faster decisions than ever. So private equity, especially like private credit just mentioned, they are really interesting area for our investors.
Sure. So actually, before I joined the insurance industry, I was in a family office. So I know, how nimble we could go. We can be very aggressive. We can move really quick, and sometimes we can stay on the sideline and wait until the market come back. But being a life insurance company, I think we have a different perspective. Because of the capital that we manage, we have a consistent cash inflow coming to the portfolio. So we basically manage according to our asset allocation framework. Of course, we add it with a tactical asset allocation considerations. But in general, I think we have a lot of considerations between like relative valuation across different asset class, not just on private versus public, but across different market, developing market, EM, etc. And even for bond allocation, every single week we basically look at the relative valuation between the different market, different sectors, and different currency as well. So I think in this market, we still take the similar approach, but we have more regular review on our tactical asset allocation strategies, especially when we see changes happen in the market. Of course, in the beginning of the year, we already know there are a lot of eventful events happening in the year. We have elections, we have interest rates, volatility to manage. So we have set out a lot of different strategies to manage our portfolio over time, and in response to different situations, we can move really quick. We have a plan ready. But of course, at the same time, when we look at where the market is today, I think private assets are still very attractive. So we have consistently finding best managers in the space. We have more than 200 meetings in just the first half of the year, meeting different managers, try to meet a lot of GPs, understand their fundraising program, see how we can, how they can fit into our asset allocation plan. So I think it's an ongoing process, and no matter how quick the market will be at, but we have the framework, we react to the market, and of course we take an active view. But I wish I have the crystal ball so I can go all in and all out, but obviously I don't. So we are taking a very, I would say, methodical approach to manage our asset to make sure we deliver stable and hopefully superior return over time when the downside is also well managed. We also use a lot of different instruments to make sure we capture asymmetric return. We maintain the upside, and while we can still protect downside. So innovations, I think, is quite integrated into our whole asset allocation framework and investment strategy and process.
Anything to add?
Is the question, where do we see the opportunity in a volatile market?
Yeah, and how your strategy is sort of evolving.
Yeah, so again, where Coolwater plays, it's at fund formation. So we're de novo many times building new firms. These are existing investors that haven't started a fund before, but they might have 15 or 20 years of investment experience. So they have a track record, but they actually haven't started a fund. So the fund we invested into last week, I'm going to give a little presentation in about 3 hours on it, but like that person has invested $1 billion, DPI'd $1.5 billion, has a 2x TVPI, but has never started their own fund. They did that at like 3 previous funds. So fund formation, for some reason, like it baffles me, but it hasn't really slowed down, at least in the US. But fund formation, I think, is different than getting funded, right? So you can kind of say, like, I'm hanging my own, shingle and I'm gonna start this fund, but then you actually have to raise the capital. So if you want to throw some like data on it, a $50 million fund in 2021 in the US, target, would probably hit their, like a good team, relatively. We can talk about what good means later. We don't have time now, but like they could hit their target and even oversubscribe into kind of, 60, 70, 80, because there was a lot of kind of, yields were low on kind of debt, and they, like, people are kind of chasing kind of new, kind of shiny objects. That $50 million target fund today, again, this is based off of data. We're going to meet with like 2,000 funds this year. They come to us, they pitch us on like new ideas. We work with maybe 100 of them. So again, this is based on that data set, like an internal data set, but like a $50 million fund, similar team, similar background, similar track record, similar number of investments, similar performance, is raising like 15, right? Like a third. And like it's harder, I would argue. I'd say they're raising for twice as long, right? So there's like, call it like a 6 or 7x change, right? And just in terms of how hard it is and what you're actually going to raise. So again, there's still a lot of interest to be a fund manager, but there's the results at the end of the road are tougher, right? Which is why I think they want to work with us. The other opportunity I'm seeing is like there's changes to the market. So again, like big picture, taking a step back, what are the themes you're seeing in the US, right? Like over 50%, it might be closer to 60% of the deals done last quarter in the US, this is all venture deals, over 50% were AI deals. So like the market is completely buzzy towards AI, but if you look at where the capital is going, right? Like 60% of secondary capital right now, this is like a private number, so I might be off here, don't quote me on this one, but like 60% is going into the top 10 names. OpenAI, SpaceX, like the names you all know, and like everyone's trying to get into those deals. So like the kind of craze towards AI, what's the punchline here? It's like you almost need to be a bigger fund. It's harder to raise a bigger fund, but you almost need to be a bigger fund. And so I'm seeing more sophistication in the fund formation of like more teams kind of thinking about partnership for longer, and then they're coming to market with like a 3 to 5 person team instead of just like a solo or 2-person team that they would have done like 2 or 3 years ago, and they're raising more. So strangely, despite the fact that like fundraising is tougher, like 7x harder according to our numbers, it's like you see more funds trying to raise like 100 to 500 now, because like if you're going to do LLMs, if you're going to do AI, if you're going to do deep tech, right? Like deep tech is higher capex. Like you have to have more dollars to put to work. So those are kind of some of the dynamics going on, where like the growth funds, the VC funds that are growth funds, are trying, like they're putting a bigger number on, which means they're going to have to go after institutions. As we all know, like institutional capital is kind of locked up as well, and kind of chasing yield, kind of higher interest rates, and like the market's there. So they're kind of let's wait to the election, let's see like what's happening in 2025. But those are the dynamics that are happening. Fund formation remains up. There's more bigger funds coming to market, which is kind of, you wouldn't expect that, but still like the bar is higher for institutional allocators, and so there's just fewer funds overall, which might mean like the funds that are getting funded, they've been validated, and if you're investing into funds, like those might be like higher quality managers, right? Like they've survived this kind of fundraising downturn, so they might be interesting opportunities for you.
I mean, if I may just add on to your point, in Asia, I see the same trends. The only difference is that we are not a new GP, right? We've been around for the last 20 years. But our strategies are constantly evolving. We are constantly adding on expansion to our strategy. So what we try to do, even if I raise a new fund, right, to your point, if I do an AI, if I do a blockchain fund, am I the best guy to do it? But then the smaller guys, like you've been pointing out, it's hard for them to start a new fund because they're considered a first-time manager. So what I try to do at Gore, we try to form partnerships, right? Because I start to be more niche in sub-verticals of my strategies within the region, Pan-Asia. So even within climate, I can't just do, sit out of Hong Kong and look at Hong Kong, right? You will have a lot of those niche platforms that are in Australia, in Korea, in Japan, but they are sort of within their own country. But I'm looking at Pan-Asia. So we try to then do sort of the partnerships. But one market that at least we think we're probably good at or strong at is definitely Hong Kong, because I'm based here, we're out of Hong Kong. So even the last 12 months, right, we actually launched we are one of the managers, right, to invest in the Hong Kong related, or I call Hong Kong Inc. companies, where it's basically helping Hong Kong companies to expand out. because I come from Singapore actually, and I quite call me nationalistic. I quite believe in the Singapore Inc. Business model, where early days Singapore has been seeding and helping a lot of their companies locally, but then all expanding outwards. And I've been here about the last 9 years now in Hong Kong, and I don't see that kind of private capital supporting local Hong Kong, because we always say Hong Kong is too small. Hong Kong is too small as a market. So where's next? You go to China. But look, where's China now, right? Or mainland China. So, founders will be very afraid to go out, but because we are so nimble, in that sense, I started to call me first-time GP for Hong Kong only, but we are able to launch new funds to support Hong Kong companies. So whichever startups or companies out of Hong Kong, feel free to find me. I have a whole team to look at that. But the point I'm trying to say is that, despite all these niche strategies that have formed, be it from earlier stage venture in prop tech to then now climate tech, infra tech, and then now and debt credit, and looking at now in this case Hong Kong related nexus, it's all because we're able to form partnerships locally on a very thematic basis to scale up. And obviously 9 years ago, if I'd known you, maybe you would have backed me, right? But it's the same thing. We're basically seeding companies out of Gore to scale. And I think that's the new strategies that we have been adopting, even in secondaries. We have platforms that we've seeded to back secondaries, pan-Asia.
Right. So following off of that, everything we've discussed, it is indeed a very eventful year. So elections, interest rates, and all of this. How is that? How's everything we discussed influencing your investments, but specifically in tech? And also, how are you implementing fintech in your businesses? Maybe, Helen, we can start with you.
Thanks. So Winter mentioned AI. So there is a massive market for AI transformation, especially the quantum computing and cybersecurity, as we see. So this market, a lot of research reports out there, but I just want to quote the CAGR of 73% through 2027. This is a figure that we can't miss. It's the same as our family offices and high net worth individual investors. So this is the one area. And also, I just want to put a little bit emphasis on the digital asset area, because for the private deal we just talked about, in Q2 2024 alone, crypto startups just secured $2.7 billion across over 500 private deals. So we have the AI-powered tools, which is really helpful to reshape the way we deal sourcing, due diligence, and do the portfolio management. So in that way, we are able to identify those millions and millions of decentralized projects among them, and then identify the high quality ones. And we also implement the AI-driven technology, like the data analyzing tools, to conduct different scenario testing, stress tests, to be able to generate the best possible high-quality, actionable data insights for our clients to make more informed decisions. So I think this is very important for a down cycle, especially after the post-COVID boom.
Yep. So just to follow up on that, I think from us, we see a lot of opportunities brought to us by technology AI. But again, I think I also want to mention a bit of how that would actually disrupt the market and some of the older technology or some of the older business model. We see some managers that during our due diligence phases, we see they have a very low loss ratio in the past. But because of the AI, I think some of the portfolio companies that they invested back years then really got disrupted. So we see some of these threats happening. But again, I mean, back to the earlier point that you mentioned about innovations or innovative strategies, new managers. I think for us being an asset allocator, we are open to support, new managers. And I think if we want to take the opportunities in AI, in the new technology, some of the time you have a different underwriting standard because you cannot find the same fund that has been in the industry for 20 years, knowing AI and been investing and generating return, low loss ratio and all that. That we invest in buyout strategies. So we have a different mindset. But overall, I think when we look at all those opportunities together, we stay diversified so we can make sure we get opportunities and keep the downside well managed.
Maybe 3 points. I'll try to be tangible. So I personally invest in this company called Pluto. They just got acquired by Robinhood. I think it's public now. If it's not, don't tell anyone. But what were they doing? They were basically like chat bots for crypto traders. right? So again, it was a combination of like fintech and AI. But if you're like a crypto trader, you kind of want information, right? Similar to if you're just like a public equities trader, you want information as like fast as possible. They actually pivoted, right, to more like serving the hedge fund industry, right? Again, like, who has the information at their fingertips? And, they couldn't make it, work to get sort of moonshot potential. So they ended up like selling to Robinhood, which is a big kind of financial technology app, right? So again, AI meets fintech. There might be exit markets aren't fully shut down. Like there's still kind of exit markets there. So that's like one tangible example of kind of where I've seen maybe it's not massive success, but it's decent success. Like the investors didn't lose all their money. The second point on financial technology is we help build firms. So we're building the back office of these firms. We actually have a CFO, Chief Financial Officer business, like in the US that's building the back end. And I think, this is a bigger picture point here, but over the last like 15 years, like the back office of an investment firm has completely changed, right? Like it's like if you took a time machine, 20 years ago and you looked at the back office, like the functions would be the same, but like the names, the tools, like how it's actually done, the black boxes behind how it's actually done are like completely different. So just from that, like it's, if you were to take like each function of tax, like, accounting, all of these things, like each one of those dimensions, there's a whole ecosystem of like tools being built to kind of deliver more efficient back offices. I think the last point I'll make is like, so there's a lot of change on the back office side, but in one of our most recent accelerator cohort over the summer, we had a firm that did, they started out of a top VC firm out of Europe. They did over 3 years of back testing. Kind of, this is one of the top performing venture funds in Europe. They did 3 years of kind of back testing, right? Maybe 10 to 20 years of performance data. And they basically built, like everyone talks about financial technology for back office, but they built kind of financial technology for front office, right? Like their whole investment model is premised off of like taking financial firms' data and then like making that be the decision maker, which I think is like, again, we kind of brought them in the accelerator because it looked different. Like we want to work with things that look interesting and different, but I think all of us will see a lot more of that, right? Like captive data sets, people building kind of models on top of those data sets. And where there's a lot of innovation over the last 20 years in the back office, I think for the next decade, you're going to see a lot of innovation on like the front office, investing, kind of disrupting kind of the people that think they're geniuses, kind of allocating capital. Some of them are, right? But it's like, can you actually turn that into an AI and turn that into like an investment strategy? So I think that's the inflection point we're seeing. Again, we see 2,000 funds a year. We see a lot of different like early insights and early trends. And this is kind of one of those trends that it's functional now. It's not just like talked about, but it's becoming more functional where like you're actually able to execute on that strategy.
Well, I'd probably just end off with 3 points, right? One, how is our group incorporating fintech or technology into our business? One, ChatGPT. I start to see better write-ups of investment memos, never than before. I start to see, my colleagues writing much better in terms of just the way we write, the way we present. Because you have international colleagues, China, Japan, Australia, Korea. It's not to say that our English is not good, but now I start to see that the memos are, very beautifully written. And I think that's how we've started to incorporate ourselves, and within the group we start to form, I think, committees to start to see how can we incorporate better technologies that each of the function groups can use that are more universal, because as a GP, the bosses also care about P&L. Which one is more expensive to use, which one creates the most impact. But it's very obvious, I can see that since the introduction of these kind of softwares, I start to see improvements. That's the first thing. Second, how am I, or how do I see this whole trend of AI, fintech, and all that in terms of my investment strategies? It's because I invest a lot into, early days, like I said, in these software companies. Now we're investing a lot into cybersecurity, and insurtech. Because I'm not an expert in AI. I'm the first to tell people I'm not an expert. But I'm a much believer that when people get hacked, with all the data that's going on, they need help. So let me go back to the back end and say, okay, let me back some of these people who know how to rescue people when they're hacked. And we just did that recently with it's almost like a Hong Kong-backed company, and we did it together with Singtel out of Singapore to invest into cyber insurtech. So again, it's things like this that when I invest in some of these cyber insurtech startups, I start to force every of the single startups I invested in to buy, or to adopt, use these insurtech and cyber products to make sure that their data is safe, right? So that's how I use that. And the final thing to end off in terms of how our hard asset strategy is also evolving, because of AI, our data center strategies is now incorporating AIDC, right? Cloud service providers, AI data centers. But frankly, Asia is still a bit lacking compared to where the US is in terms of where AI is evolving, even for data centers, because then a lot of these are still in the learning mode. Because it's the learning mode, the data centers we look at, they don't really need to pay the highest rent in the best locations for these LLM models. So from 3 points, like I said, one, we are using technology better to make our work processes better. Second is I'm actually investing into cybersecurity and insurtech as an evolvement of the strategy. And then thirdly is AIDC is a big focus for us.
It's been great to hear from all of you. It's been very interesting to hear about a more emerging manager North America perspective versus public-private markets in Asia. Thank you to the audience for joining us here today, and thank you very much to the panelists for the very insightful discussion.
Thank you.